So SIP is perhaps the best available tool to any of us to remain invested and enjoy that compounding journey for a longer period of time and not get frustrated. Hello, everyone, and welcome to our channel, The Mutual Fund Guys, where we only speak about mutual funds. I am Samir, and with me is Mahesh. Both Mahesh and I are partners at AMS Investments, which is a mutual fund distributor based out of Mumbai. So today topic is we all have heard about and the topic is SIPs, systematic investment plans. We hear it on every news channel, TV channel, and the tagline is that SIPs are great, SIPs are good for you, SIPs help in building long-term wealth, etc. So today, I think the attempt today is to showcase the importance of SIPs. We want to drill down and give you actual numbers and also give you some of the psychological advantages that SIPs bring to our investment journey. I think it's more about the psychology and the process or the experience that the investor goes through when he does a lump sum investment versus an SIP investment. And there are two different experiences which we'll talk about, right? So we looked at data, Mahesh, you and I both looked at data, and we saw that if you invest a lump sum amount of money, there is a possibility that you will get very low return for an extended period of time. Okay. So we looked at a 10-year return period, which is a long enough period for any equity investor to be invested. And we saw that there could be instances where the return on a 10-year basis could be as low as 6%, 6.56 to be exactly accurate.
Okay.
So an investor could have invested a lump sum amount in a particular time, okay, and he would have seen his wealth not grow at all, only by 6% over a 10-year basis, right? There are a few instances there, but it's something that you want to avoid, right? So I'll give you an example. So in January of 2008, the Nifty was at, I think, 6,500.
Let us speak.
If anybody had invested at that point in time, okay, in 2008 at the top, okay, when there was a lot of euphoria in the market, everybody was talking about stock markets, and I know a lot of people who invested also in 2008, right, including myself. What would have happened is in 2008, when the market peaked off and you had invested then, obviously you would have seen a big fall in the market, which would have really dampened your spirits, but you would have not seen the market recover back to its original price of 2008 until 2014. This is when the Narendra Modi government came into power, right? So the point is that it was a very frustrating time to spend, for 6-7 years, basically seeing your money not grow at all, flat. But had you taken an SIP route, okay, had you invested some amount of money in 2008, which is fine, and then had a process of actually investing year over year over the next 1 year or even 2 years, you would have actually got a very good average price in the market, and your returns would have been much more sort of satisfactory, if I would say, right, if you had done an SIP. So SIP actually is obviously logical. It helps you to address the volatility, but it also helps you to stay invested in the market because you have not put all your eggs in one basket at one point in time.
Correct.
You're staggered your investments.
Point in time,
yeah, you're staggered your investments. You've got the ups and downs in the market, and hopefully that SIP investing has helped you get better returns than you would have got in a lump sum. Lump sum also sometimes has worked in favor of a lot of people as well. Some people have bought lump sums at the bottom of the market and have now seen very good returns. So it works both ways. But generally speaking, I think I don't think any of us has the ability to time the markets. If you happen to get the market at the right time, you essentially got a bit lucky. But to repeat that over and over again is not easy. So SIP is perhaps the best available tool to any of us to remain invested and enjoy that compounding journey for a longer period of time and not get frustrated if you had done a lump sum investment and had to wait for 10 years. I mean, I'll give you an example. Microsoft is a stock. It's not a mutual fund, but Microsoft peaked out in 1999 actually. It took 17 years for Microsoft to actually come back to the same original price that it saw in 1999. I mean, so it went down almost, it was going down, then it kind of flattened out. So if you believed in the story of Microsoft, let's say, and you're invested in that 10, 17-year period, okay, and now enjoyed the benefits of it going up and being the largest company in the world, that experience would have been a lot different than investing in 1999, holding on for 17 years, not made a single penny. And I'm sure that after 17 years, you would have said, okay, you know what, I'm done with this investment. I don't want to remain invested anymore. Similarly, with mutual funds, you invested in 2008, for example, you waited for 6 years, you got your price back, and you would be, you know what, I waited for 6 years. I don't believe in the story anymore. I could have made a better return somewhere else. So I'm done with investing. And then you would have seen your investment grow quite a bit because markets also did well and they started to compound. This again ties with the fact that we always recommend to all our clients to do an SIP versus lump sum, or do small amounts of lump sums as they feel fit over a couple of years or a couple of months, just to make sure that they are not one of those unlucky people who invested on the top and were very frustrated throughout that journey, right? So that is what I think. I think this is where SIPs really shine through. It's your ability to remain invested in the market for a longer period of time as opposed to doing a lump sum.
Yeah, correct. And the other thing is that in my experience and in our experience, we have seen that clients or investors, they don't really do a SIP. If they don't do a SIP, that money accumulates in their savings account or in their FDs. And then sometimes, when we have this experience, right? Money lies in our account, we find ways to spend it. Suddenly, I find a need for a new mobile or a new laptop or the latest Fitbit or whatever, right? You know
Yes.
how money gets spent if it is there in your savings account. And so people think we will not do an SIP. I will be smart enough to do a lump sum at the right time.
Yeah.
But that generally never works because the money itself goes out of your account. So I always say that if your income is greater than your expenses, then whatever is remaining is your savings, but that's not your investment, right? So
Yes.
that is just savings. And that savings can be spent in one-time expenditure for some frivolous thing, you could just spend it away. So an SIP is also a way of disciplining yourself and ensuring that that savings converts into an investment.
Yeah,
And
these
then
savings
remains.
have to, yeah, the savings have to be productive. It cannot
Yeah,
just be savings. Most consumption goods, most things that we consume, they don't provide economic benefit for later years, right?
yeah,
I mean, you buy an iPhone today, it's not going to provide you any value after 20 years or 10 years or 5 years also, right? It's you consume it. So what typically happens is that you have an income of say 100 and you spend 80 on expenses such as house rent or whatever. You have 20 bucks and you say, I have 20 bucks. I'm going to wait till the market gets lower or whatever, and I'll buy. Sometimes what happens in that process of waiting, you forget also that I need to invest, right? And
yeah,
then you go and buy your iPhone, or you go get a nice dinner. And then that saving, which was a good thing that you did, but is no longer productive anymore because that has been eaten up into something else.
yeah,
There's a joke, right? About two friends talking, and
yeah,
one friend saying so the one friend asked the other friend, how many beers do you drink? So he says, I drink 3 beers a day. So he says, how much do you spend in a day? 3 beers is quite a bit of beers, man, to drink. And he says, I spent 1,000 rupees per day on beers. So he said, oh my God, like 1,000 rupees, like let's say you drink 20 days in a month, so 20,000 rupees a month. And over a year is like 2.5 lakhs or 2.4 lakh rupees, right? And over a 10-year period, that's like 24 lakh rupees. If you just, 24 lakh rupees is a lot of money also, okay? That you can buy yourself a nice SUV or something, right? So the question is that guy spent all his money into, not spend all his money, but spend some of this large sum of money on alcohol. And the other friend who doesn't drink, okay, obviously did not drink. So he saved this money. So this friend who said, okay, so I drink, you didn't drink. So where is your car? Where is your Hyundai Accord, sorry, your Hyundai Creta or whatever you're claiming that I could have bought. with the money saved. So the point is exactly to what you said, that even if you didn't have these expenses that this person had,
Yeah.
what did you do with your savings? Did it lie in the bank account and you got a 3-4% interest on your savings account, or a 7%, or even 5% post-tax return on your as an interest over 10 years? It didn't get you very far, because that would not really buy you a lot of things because of inflation over the next 10 years, right? So SIPs are essential, that you commit yourself, like we talked about the Ulysses Pact, right? You commit yourself that you are going to take this money out and put it into something more productive, which then in turn generates more wealth. So I think SIP is like almost like a living being, right? It's like you've sent a worker to work for you every month. You kind of hired a person to work for you, and that person gets you income every month, right? Over a period of 10 years, 15 years, 20 years, 30 years, what have you. I always think of that. I think of SIP investing or any kind of investing as you have actually employed somebody to do some work for you, and then they're giving you the returns back home. I mean, that's how I think of it. And I hope that
more than anything else, it is a way of disciplining yourself and ensuring that money gets out of your account and becomes productive. Yes. But also, more importantly, it at least gets out of your account so that you don't spend it on unnecessary stuff, right? Because my belief is that if I have money in my bank account, then I will find a way to spend it. I'll find that's actually the word. I'll find a way to spend it. I will not invest it. If it is lying with my bank account, I'll find a need for a new laptop. I'll suddenly need some painting to be done in my house. I'll see some expenditure and it will go.
And you'll be surprised how we make these very impromptu decisions to buy things, right?
Yeah, I mean, it is completely impromptu.
And it's most impromptu when you have the money in your bank account.
Yes.
It's not very impromptu when you don't have the money in your account. I mean, if you don't have 50,000 rupees in your account or 1 lakh rupees in your account, you are not going to think of buying an iPhone for sure.
Yeah.
You're not going to buy it. You might think of buying a t-shirt or something. But again, it's money spent, right? My father always told me that SIP in his mind is like a tax. Okay. He thinks that it's something that one has to do. It's like, there's no escaping taxes, right? It's a money on your account which should just go away. And it's obviously in the good part about SIP is that it's actually not a tax. It goes for into your own kitty, and it makes money for you, right? But in your mind, you should think that, okay, this is something that should happen. It has to be done. So there should not be any questions about it. And we explained in the video the benefits of it, psychologically speaking, as opposed to timing the market or investing at the wrong time, being unlucky with your timing. And you'll never know until you actually go through those 10 years. You might think you've timed it right, but then you have to wait, right? How do you know? You have to wait for 10 years or 5 years or 6 years to know, okay, oh my God, I probably mistimed it, or had this was not the right entry point. Had you just invested regularly over the 5-10 years, then there is no question in your mind that you're timing it right or wrong. You're just going with the process and not the outcome at that point. Perfect. Okay. So I hope this video helped you understand the benefit of SIPs, more psychologically speaking, as opposed to more numbers. And it certainly helped a lot of clients and a lot of investors. And we hope that all of you all take this path of SIP investing, remain invested, and leave the market timing to the so-called experts, and focus on the process rather than the outcome. And for any other questions, you can write to us at AMS Investments. hello@amsinvestments.net. And we'll be more than happy to answer any questions you might have. Thank you for watching.
Bye.